Welcome back. Today's topic is cost volume profit analysis. This is one of the part of marginal costing. We'll learn about cost volume profit analysis, which is also known as CVP analysis. So let's get started with the meaning of cost volume profit analysis first. Now, cost volume profit analysis is a technique, which is used for showing the interrelationship between cost, sales, and profit. Cost, volume, profit. Now, when we see the relationship between cost, volume, and profit, if we have any kind of changes in cost, in change in volume, then what is the change we have in profit? These are all interrelated. If cost is increased or decreased, if volume is increased or decreased, what will be the effect of those changes in the profit, whether the profit will increase or decrease? Now, this CVP analysis, we commonly call it as CVP analysis. This is used mainly for profit planning. If in order to get certain kind of profit, what kind of decision, what kind of planning the management have to make. For that reason, CVP analysis is used. Mainly for overall, if you see overall profit planning and controlling the management, budgeting is used mainly, but in the CVP analysis we just see an overview of the profit planning process, how the management is going to earn profit in the future, and what are the costs, how the cost can be reduced, how the volume can be increased. All these analysis will be done in the CVP analysis, and it is mainly for profit planning process for the management to proceed further. So this is the meaning of CVP analysis. Now this CVP analysis, it answers so many questions. What are the main questions which the CVP profit analysis answers? Generally, CVP analysis provide answer to the following questions. Now, first question, what is under CVP analysis is what will be the effect of changes in price, cost, and volume on profit? If there is changes in price, if there is some change in cost, if there is some change in volume, how these items, how these changes are affecting the profits, how it will affect the profits changes. So this is one question which is answered by the CVP analysis. Next question which is answered is what minimum sales volume need be affected to avoid losses. Now minimum sales means in order to avoid losses, your cost have to be exactly equal to sales, right? Suppose you are buying something at 10 rupees, and if you are selling it in 10 rupees, you don't get any profit or loss, right? But you are not having any kind of loss as well. So in order to avoid that, the cost of any material or any product have to be same with the sales. There should be a minimum sales volume, for avoiding any kind of losses. In order to get the profit, the cost have to be more than the cost have to be less than the selling price. Suppose the cost, or if you have bought any products of rupees 20 rupees and you have sold it at 30 rupees, you have a profit of 10 rupees, right? But in order to avoid losses, loss, how it can happen? If suppose you are buying a product at 10 rupees and you are selling it at 9 rupees or 8 rupees, you are having losses, right? So in order to avoid those losses, at least there should be a breakup of the sales and the cost in such a manner that the sales and the cost is equal, so that you don't get any profit also or you don't get any losses also. So to understand this, the minimum sales volume, how it to avoid those losses also, CVP analysis is used. Next question is which product is more profitable and which product or operation of a plant should be discontinued. Now those product where you are selling those product and you are getting certain kind of profits, whether they are profitable to you or not, you have to see it. And if certain products, after selling those product, you are suffering any kind of losses or you cannot sold those product in the market, then those products have to be discontinued. The manufacturing of those or the production of those uh, products have to be discontinued, right? So for understanding which product by manufacturing or producing which product you are getting more profit and which product are those where there is no profit, you are not getting any profit by selling those product, then those product have to be discontinued. So these are the three main questions which are answered by the CVP analysis. Okay. Now CVP analysis, there are relationship between cost, volume and profit. Okay, for understanding this relationship we have to understand four concepts of the CVP analysis. The mathematical relationship. Okay, mathematical relationship, if we say, that means we have to use certain formulas and calculations to find out whether the company is going to earn profit and what should be the change in the price, what should be the change in the cost, volume of a company. So for calculating this, we have these four concepts. Now first concept is contribution, PV ratio. PV ratio stands for profit volume ratio, break even point and margin of safety. Now contribution, what is contribution? Contribution will be the difference between sales and the marginal cost of sales. Whatever sales value we are having, from there marginal cost have to be deducted. Now marginal costs are nothing but the variable cost. Whatever variable costs are there in the company, variable costs are those costs which changes according to the volume of output. And contribution, how we can find it? We can find it by the deducting the sales value with the marginal cost or the variable cost. Now in this contribution, it helps us to find out the profitability of a product, any kind of department, in which department they are having certain kind of profits better, which department is performing better, what kind of product mix they are using, how the planning has been taken place for maximizing the profit. This contribution is helpful for finding out all those details in a company. Now for calculating this, since this is a mathematical relationship, we need to have a formula. So what is the formula for calculating contribution? Contribution is selling price minus the marginal cost, or we can say sales minus variable cost. Now this formula, again, it can be written in this way, that is contribution is equal to fixed expenses plus profit. Whatever the expense is fixed nature, which does not change with the volume of output, from there you have to add the profit. Okay, fixed expenses plus profit also gives us contribution. Or again, this contribution can be written in this way, like contribution, whatever fixed expenses plus profit was there, right? Now fixed contribution minus, you just bring these fixed expenses in the right hand side, you can see fixed contribution minus fixed expenses is equal to profit. So either of these formulas we can use it to calculate the contribution value and to know the profitability of any product or department or any kind of division which has been made in the company. Okay, so either of these formulas are very important, so you need to understand the formulas as well for solving any kind of numerical problems. So this is the first type of CVP analysis. Next is the PV ratio. The most important part of this analysis is PV ratio. All the calculation mainly is based on PV ratio. Now PV ratio stands for what? Profit volume ratio. Now profit volume ratio, it shows the profitability of the business. Okay, we talk about how much profit you are going to earn if you are changing the value, or if you are changing the volume or the output of certain products. Okay, and it shows the relationship between contribution and sales. So what is contribution? Contribution is sales minus variable cost, and if we divide that contribution with the sales, we get the PV ratio. Now we have to keep in mind that whenever the PV ratio is more, the profit will be more, and if the PV ratio we get, whatever PV ratio we get, if it is less, then the profit also it will be automatically less. Now how this PV ratio can be improved? PV ratio can be improved with the increasing the selling price per unit. If we sell 1 unit of a particular product, if the selling price is more, by increasing the selling price, then we can at least get a higher PV ratio. And we can improve again by reducing the direct and variable cost. Now direct and variable costs are those costs which are changing according to the volume of output, right? So if we try to utilize the labor, the machines, the materials in an optimum way, in a maximum level, if we use it, then we can reduce those costs. Okay, utilizing the labors are coming for work and they are not going for different works and all those things. So we are keeping those people as worker, and they are utilizing the materials, the machines properly in the organization. Then the direct cost or the variable cost can be reduced. And switching to the production to more profitable products, and switching the production to more profitable products means those products which are after manufacturing, after the production, those products which are giving you the more profits, okay, we will be concentrating to put more effort in making those products. But those products which are not giving any kind of benefits, any kind of profits for the company, then those products can be discontinued. Okay, so for this PV ratio, it can be improved by increasing the selling price, reducing the direct variable cost, and we can produce those products which are giving you more profits. So for this PV ratio also, we have a formula. So this is PV ratio is equal to contribution divided by sales into 100. So contribution divided by sales into 100. Now into 100, if we are saying, that means it is denoted in percentage form. Now PV ratio will be always in percentage form. Another formula for PV ratio will be change in profit divided by change in sales. If the profit changes are there in different years, then we can take the change, whatever change is there in the profit for 2 years, and the change in sales for the 2 years, then we can find out the PV ratio in this formula as well. Next is break even point. Now what is break even point? Break even point is that point where the cost of a product and the sales of a product is equal. Okay, there is no profit, no loss. You don't get any profit, you don't get any loss. And CVP analysis also answer that question, right? That to avoid the losses, the company should have a break even point. Now what is break even point? It is that point where there is no profit or no loss. We can say it in other words, that the sales is equal to the cost of the product, or we can say that contribution is equal to fixed cost. Because when we minus contribution from the contribution minus fixed cost, it gives us profit or loss, right? If the contribution is more than the fixed cost, then we are getting profit. If contribution is less and less than the fixed cost, then we are getting loss, right? So in order to avoid that, if you don't want any profit, then you should not suffer any kind of loss as well, right? So in case you don't want to suffer any kind of loss, then the break even point have to be there, where the contribution should be equal to fixed cost. So that is known as break even point. Now for calculating break even point also, there is a formula. That is, first formula is break even point in units. In units, per unit basis, how to calculate. That is your all the total fixed expenses, or you can say total fixed cost, divided by contribution per unit. Next is break-even point in rupees. Break-even point in rupees is fixed cost divided by PV ratio. So for that one, for calculating this break-even point in rupees, we should know what is the PV ratio. Okay. After calculating the PV ratio, then only we can calculate the break-even point in rupees. Or else in break-even point for calculating in rupees, there is one formula, that is, after calculating the break-even point in units, you can multiply it with the selling price. Okay, then also we can get the break-even point in rupees. So this is break-even point. Next is margin of safety. Now margin of safety, it is just the difference between actual sales and the sales at the break-even point. Actual sales means how much actually the sales has been done, and it have to be minus from the break-even point. Now break-even point where the total cost and the sales becomes equal, right? So there is no profit, no loss in break-even point. So but from this value, you have to minus the actual sale, actually how much the sales has been made. That is called the margin of safety. Now when the sales or output is beyond this break-even point where the contribution is equal to the fixed cost, right? You cannot get any profit, you cannot get any loss. But then if your sales is little bit more than the break-even point, if the contribution is more than the fixed cost, then you have a profit, right? And that profit beyond that break-even point, it is known as your margin of safety. Now margin of safety, if it is the profit level, okay, the profit level, if it is more, the margin of safety is higher, then it shows that the business is strong enough to earn profit in the future. Now, how the margin of safety can be increased? Margin of safety can be increased with these following 4 steps. That is, first is increase the level of production. Whatever the production process you are doing, that level have to be increased. Okay, production level should be increased. Increase the selling price. Obviously, that sales have to be more than the cost. You can increase the selling price, then you can definitely get a higher margin of safety. Next is reduce the fixed or variable cost, or both. You can reduce the fixed expenses, whatever is there in the company, or the variable cost to the minimum. If you can keep the variable cost and the fixed cost to the minimum, or both, then you can increase the margin of safety. And then substituting the existing product by more profitable products. Now it says the same thing. Those products which are giving you more profit, you keep those production, you keep on doing the production for those products, and release those products which are not serving you any kind of profits, which are giving you losses after losses. Then those goods have to be substituted. In that case, if we do all these four steps, then the margin of safety can be increased, and if it is increased, then the business can be strong enough to exist in the market. Now for this margin of safety also, we have a formula. That is, margin of safety is actual sales minus the break-even sales. See the actual sales first, how much sales the company is making, and then minus it with the break-even sales, or margin of safety is equal to profit divided by PV ratio. Now whatever profit, if the company is having any profit, that have to be divided with the PV ratio. Now PV ratio formula is contribution divided by sales. After calculating the PV ratio, then only we can calculate the margin of safety in this formula. Next formula is margin of safety in units. In units, how to find out? We get the profit, whatever profit we get, it have to be divided with the contribution per unit. Contribution per unit will be again sales minus the variable cost per unit. So based on the questions, you have to put up these formulas. In the questions, sometimes the information about this might not be given. If it is not given, you check out for the next formula, whether this formula is fitting in that question or not. If this formula is also not fitting in the question, then go for the next formula, which formula will be fitting in the question. As per the question, you have to put up the formulas. Okay, the formulas are not fixed that only this formula you have to use, or this formula you have to be used, or this formula you have to be used. Okay, it will be based on the question, and in the question whatever information will be given, according to that you have to put up these formulas. You can put these formulas, or else these formulas, or else these formulas. Okay, based on the questions. So these were all the 4 concepts of CVP analysis, and I hope you have understood this CVP analysis properly. If you have understood it, please like the video, and thank you.